Hello, everyone, and welcome to The Buck Stops Here. I am Catherine Murray. Well, one of my favorite sectors to discuss and analyze and also invest in, I've been a heavy investor in the energy sector since 2020, is obviously the energy sector. I think it's really important to understand what the fundamentals are, where we're at right now from a structural perspective, the fact that we still need oil is my belief, and therefore how to invest. So for that, I have Eric Nuttall joining us. He's an energy veteran. And he is a partner and senior portfolio manager at Ninepoint Partners. Eric, great to be with you today. I know a lot of people like to hear what you have to say, so thanks so much for giving us your latest and up-to-date thoughts on the energy sector.
You bet. It's always great to be with you.
Thank you. So why don't we start from the top-down perspective? How are you looking at the energy sector from a supply and demand perspective? That's key as it relates to what the price of oil is, and then of course the stocks take that into account in terms of price performance.
You bet. So we remain bullish on oil, and I would kind of describe that as we're more bullish than the strip. We're not calling for $120, $150 oil in the next couple of years. But what we do think are that fundamental support an oil price of about where we are now. So that's about $80 WTI. There's a few different driving factors to that. One, demand, second, supply, and then that is expressed in inventories, which as of today sit at their lowest levels in history when you look at it on a seasonal adjusted basis. So what's driving that? There is a tremendous ongoing concern about the health of the US consumer, the global consumer, this worry that the certain pockets of the world are either weak or about to become weak, enter into recession, the demand that'll have, or the impact that'll have on demand. What we're seeing is demand remains fine. I define that as we're looking at annual growth of about 1.2 million barrels per day year over year. So that's in line with historical context. The real drivers of our bullish thesis now revolve around supply. What we see is a dramatic slowdown in the pace of growth coming out of the US, predominantly shale producers. They caught us off guard. They caught the street off guard last year where they grew by about 800,000 barrels per day. There were a couple of reasons for that, which we were strongly discussing why we would see this year a tremendous slowdown in growth, and we're seeing that. So in fact, US production is falling if you look at leading time indicators. The other factor that I think the market is not understanding properly, which we can discuss at length, is OPEC plus. The will and intent of certain individuals within OPEC plus. What are they trying to achieve? They have removed barrels off the market. They're scheduled to start bringing them on in October. And the market is now obsessed with this belief that, well, demand must be weak because we're heading into a recession, etc. Here you have OPEC Plus about to flood the market with barrels, and we've seen the oil price sell off on that. What people are missing is that OPEC Plus is extremely responsive, and they're very, very adept at monitoring market conditions, both reality and the perception thereof. And it's always been market dependent, data dependent. And so when His Royal Highness Prince Abdulaziz bin Salman, the Minister of Energy of Saudi, says, I've got to see it to believe it in terms of the inventory draws, etc., my own belief is we will not see the return of those barrels from OPEC for another 6 months until we get past the seasonal weakness in demand in Q1 of next year. So putting that all together, what do we see? We see US shale growing at a fraction of what they have historically. We see most basins in the world in terminal decline, with a few exceptions such as Brazil, Mexico, and Canada. We see OPEC Plus managing volumes, curtailing production levels and export levels to draw down inventories, and they have successfully done that. But at the same time, that means that they're sitting on spare capacity, which at some point the market will have to absorb. So I think that happy medium is about $80 WTI, $85 Brent. That's probably a little below what some OPEC members want. It's probably slightly above what some US politicians want, but it's that happy medium. And so at that oil price, we can then talk about the energy stocks, because the biggest theme we've talked about together in other areas has been the free cash flow that these companies are generating. I still don't think the market and people appreciate just how unbelievable these business models are at $80 WTI.
Absolutely. We will talk about that. I do want to get your take before we delve into some of the great fundamentals of these companies, a little bit more on the structural supply issue. We'll take a break. We'll be right back.